Let's look at what's actually happening. Most investors think a market crash is when wealth gets destroyed. The data tells a completely different story. In March 2009, at the bottom of the financial crisis, the S&P 500 hit 660 points. Anyone who invested $10,000 in a simple index fund at the exact moment when every headline screamed sell and every neighbor was panicking, watched that $10,000 grow to over $85,000 by 2025. An 8.5x return in 16 years. That's not because they timed the bottom perfectly, it's because they understood something that panicked sellers did not. A market crash isn't when compounding stops, it's when compounding accelerates. And the strategy to capture that acceleration isn't complicated. It just requires understanding three mechanics that almost nobody explains properly, and being mentally prepared before the next downturn arrives, not during it. If you've been investing through any volatility recently, you've probably felt the pull. The market drops a few percent. Your portfolio shows red. Your stomach tightens. Some part of your brain whispers, maybe you should sell before it gets worse. Wait it out. Move to safety. That instinct is exactly what separates the people who get rich from market crashes from the people who get crushed by them. Not because the instinct is unreasonable, it's deeply human, but because the math of compounding rewards the people who do the opposite of what their instinct demands. When the market crashes, every share, every fund, every asset goes on sale. That's not a metaphor. It's the literal mechanic. A stock that traded at $100 in January and trades at $60 in March isn't a different stock. It's the same business, the same earnings, the same future cash flows, just temporarily marked down by 40%. Here's the math that makes this powerful. If you're investing the same dollar amount each month, say $500, a higher price means you buy fewer shares, and a lower price means you buy more. That's called dollar cost averaging, and it's the simplest investment strategy in existence. But during a crash, dollar cost averaging stops being just a strategy and becomes a wealth building accelerator. Take a real example. Imagine you invest $500 into the S&P 500. In a normal year at $100 per share, that buys 5 shares. During a 40% crash to $60 per share, the same $500 buys 8.3 shares. When the market eventually recovers, and historically every single S&P 500 crash has fully recovered, those 8.3 shares are now worth $830, a 67% gain on the contributions you made during that discount window. The contributions you made before and after the crash earned far less. This is why economist Charlie Munger, Warren Buffett's longtime business partner and one of the most quoted investors of the last 50 years, famously said, "The big money is not in the buying or selling, but in the waiting." Translation, the wealth isn't built by predicting the bottom. It's built by being mechanically committed to keep buying when prices are low, especially when every signal around you is screaming to do the opposite. The second mechanic is the one most explanations of compounding skip entirely. It's about when compounding does its real work, and crashes accidentally hand you the most valuable thing in the entire equation: time. Compound interest grows exponentially, which means the back end of the curve is where wealth is actually built. Money invested in year 1 of a 30-year horizon ends up worth dramatically more than money invested in year 20, because it has 19 extra years of compounding stacked on top of it. Here's why crashes matter mathematically. When you buy at a 30 or 40% discount, you're effectively buying a position that would have cost you significantly more during normal conditions. That extra purchasing power gets compounded over the entire remaining horizon. Buying $10,000 worth of shares at a 40% discount means you control about $16,700 worth of equivalent post-recovery shares. Those extra shares compound for decades. Now, some of you are probably thinking, but what if the crash gets worse? What if I buy and the market drops another 20% the next month? Honest answer? It might. Nobody can time bottoms. But that's exactly why dollar cost averaging through a crash works better than trying to catch the exact low point. You don't need to be right about the bottom. You just need to keep buying as prices fall, which mathematically guarantees you accumulate shares at the average crash price, not the peak. Over a 30-year horizon, the difference between catching the perfect bottom and just consistently buying through the crash is statistically minimal. The difference between buying through the crash and panic selling is everything. The third mechanic isn't financial, it's psychological. And it's the one that determines whether the first two mechanics actually work for you, or whether you panic sell at the worst possible moment and lock in losses. Here's the data. Research from Dalbar, the leading firm tracking investor behavior, has consistently shown that the average individual investor underperforms the market by roughly 4 to 5% annually. Not because the market is rigged, not because they pick bad funds, because they buy high during euphoria and sell low during panic. Over 30 years, that behavioral gap compounds into hundreds of thousands of dollars in lost wealth. And here's where it all connects. The discount window only matters if you keep buying through it. The time multiplier only matters if you don't reset the clock by selling at the bottom. Both mechanics are mathematically guaranteed to build wealth, but only if your behavior cooperates with the math. This is what smart investors prepare for before the crash, not during it. They define their rules in advance. They automate their contributions so the decision isn't up for daily debate. They turn off price alerts during volatility. They write down on paper what they'll do if the market drops 20%, 30%, 50%. Not because they're predicting it, but because emotion has zero leverage over a decision you already made when you were thinking clearly. If you just connected the three mechanics in your head, discount window creating cheap shares, time multiplier compounding them over decades, behavioral edge keeping you in the trade, you understand why crashes build the largest fortunes in any generation, and why most people miss the entire opportunity by reacting instead of preparing. Here's what activating this strategy looks like in practice, depending on where you stand right now. If you are a beginner with limited savings, your highest leverage move is automation. Set up an automatic monthly transfer of whatever amount you can sustain, even $100, into a low-cost broad market index fund like VU or VTI. Set it and don't touch it. The amount matters less than the consistency. $100 a month started in your 20s becomes meaningful wealth by your 50s, and your monthly contributions during any future crash will be the highest performing dollars in the entire portfolio. If you have an established portfolio and some cash on the sidelines, build a written crash plan now, while markets are calm. Decide in advance what percentage of your cash reserves you'll deploy at specific market drawdown thresholds. Maybe 25% of your cash at a 15% drop, 50% at a 30% drop, the rest at a 40% drop. Write it down. The exact percentages matter less than having a pre-committed rule. When the crash arrives, your job becomes execution, not decision-making. That single shift is what separates wealth builders from panic sellers. If you're close to or in retirement, your goal isn't to maximize upside from the next crash. It is to protect what you've built while still benefiting from the discount window. Maintain a meaningful cash and short-term bond position so you don't have to sell stocks during a downturn to fund living expenses. Then, keep contributing whatever you can to equity positions throughout. You won't catch the full 10x recovery a younger investor might, but you'll capture meaningful gains while preserving your capital base. Different stage, same underlying principle. Here's the number that frames everything we just covered. Between 1928 and today, the S&P 500 has experienced 26 bear markets, declines of 20% or even more. Every single one of them eventually recovered. The average bear market lasted roughly 9 to 14 months. The average recovery to new all-time highs took about 2 years from the bottom. That's the historical pattern that's held for nearly a century. Crashes are not the end. They are the discount. The investors who get rich from these moments aren't the ones who predict crashes. They're the ones who prepared for crashes when nobody was talking about them, then executed their pre-written plan when everyone else was panicking. Do one thing this week. Open a notes app or a piece of paper and write down 3 things. Your monthly automatic investment amount, the percentage of cash you'll deploy at a 15% drop, and the percentage you'll deploy at a 30% drop. That's your crash plan. Save it somewhere you'll find it again. And when the next downturn arrives, you won't need to think. You will just execute. Tell me in the comments, what's your pre-written crash plan? Or are you just still figuring it out? I want to hear where people actually stand. If this gave you a framework you didn't have before, subscribe. We break down the hidden mechanics behind compounding, market cycles, and long-term wealth building every week. None of this is personal financial advice. It's education so you can build your own framework and make decisions that fit your life. Now you see the pattern. The only question is what you do with it.